Well, hello and welcome to Trading Blows from TraderX. Another busy show this week. A bit of a central bank bonanza going on. Myself and the panel dig into last week's decisions from the Fed and the ECB. We might touch on the Bank of Japan as well. We'll look ahead to the Bank of England decision on Thursday after another disastrous inflation print out of the United Kingdom. And we'll also have a chat about how to trade summer markets as the sun comes out and the cricket season kicks off and volatility falls across the board. Without further ado, let's get into the show. So as always, a busy show ahead. You know the rules by now. The better the answer, the more points a panelist will score. We're going head-to-head over 4 rounds as usual, and the threat of being Let me start that again. The threat of points being chalked up looms over them. I'm taking a point off myself for that one if a dispute is raised over their answer. Joining us on the show today, Ryan Paisey, who is as happy as a sandboy there, the founder of PiQ Suite. Ioan Smith, a market veteran of the sell side in his own research firm. And Richard Matthews, an institution of the City of London, who's been here since the Jam Pot was a coffee house. Without further ado, let's get into the first round. And we'll start with Mr. Matthews this week. The Fed, interesting one last week. Rates unchanged as we expected at 5 to 5.25%. The dot plot, pretty hawkish, I'd argue. The forecast, pretty hawkish as well. Powell, pretty punchy in his press conference. And of course, we hear from him on Capitol Hill later this week. But the thing is, the market doesn't really seem to be buying what the Fed is selling. Why do we think that is, Dick?
It has to be buying what the Fed's been selling for months now, has it? Let's be honest. It's just I think, actually in total denial of the Fed's actions. I guess he's going to come out again and be pretty tough this afternoon in front of Congress, despite the lovely Elizabeth Warren's views on him. I think he's going to come out. I'm just not quite as convinced as I was that you're going to get another 2 hikes. I thought he sounded a little bit hesitant about that, but I think one's nailed on. God knows why the markets won't buy into it, but then you look away and there's 1 or 2 sort of signs in the horizon the recession's coming. They are going to hike until you get a recession, the same as the ECB. God knows what the Bank of England does, but we'll come back to that later on. It's too early to mention them in the day. But I think the Fed's going to hike until you get a recession. A couple of interesting.
Sorry, can we just stop the clock? Because I had 36 seconds until Dickie was going to slag off the BOE, and I just wanted to know if I won the sweepstake.
I would have been selling 36 seconds if I knew this.
Sorry, carry on.
So there's a couple of interesting, 2 or 3 interesting things I've seen. That the last time that CPI declined for 11 straight months was in 1921, which was not one of the.
That was when you started on the floor, wasn't it?
Right?
But I said that was when you started on the floor, wasn't it?
There you go. God. Yeah, I think actually you ought to change your introductions to this. You all know how it works. I end up losing and I get a wooden spoon. So that's the rules of the game. Anyway, so the last time that happened was in 1921. Money supply is declining very, very rapidly. I think it's the 7th fastest decline in money supply that we've seen. 5 out of the previous 6 held in depressions. Cheering man that I am. And the other one was in 1893, which was way before I was on the floor, which actually held at the start of the Fed. So I think there's some signs there that things are starting to get a bit wobbly. But then you see housing data come out strongly yesterday. But I think there's an anomaly in there, which Blake Morrow tried to explain to me last night, that people aren't selling houses because they want to carry their mortgages with them and keep the interest rates where they are. So there's a demand which is leading to new housing being built. But generally, I just don't know why markets don't believe it. I mean, the yields on the S&P and bills and bonds is all pretty much the same now. Just stock markets don't want to believe it.
I think that's really interesting, actually, your last point there, and I hate to give credit to the FT. It pains me to do it, but they did have a very good chart on that, where, as you say, the yield on, I think, 3-month bills, the S&P's earnings yield, and investment-grade corporate debt is pretty much the same, about 5-ish%, if not slightly under that.
First time ever in it that they're all at exactly the same point.
Yeah, exactly that. And it does kind of make you question, well, what is going to push investors to take on more risk? But I'm sure we'll get on to that in a second. Ryan, let's go to you. I mean, the thing for me, I guess, and this is something that I think a few people are struggling to get their head around, is if the Fed has sat there and going, we're going to hike another 50 basis points, why not just do it? What are they going to learn in the next 6 weeks before they maybe go or don't go again in July?
So on that, where do I stand on that? Firstly, I don't believe for a second. I'm
standing now.
I'm definitely in the minority I feel like I am in the minority when I say that whatever they do, it's not going to have an impact on today's. Oh, sorry, done something weird. It's not going to have anything. It's not going to have an impact on today's inflation, right? So we know monetary policy lags. So my argument is, do they need to do 50? I don't think they do. If they did, I see your point where, why wouldn't they just do them in one go? But we know that's not how it works. It needs to be like a step process, just because that's just because of convention, right? But as I said just now, the raising rates at this precise moment will not help inflation data prints for the next 3-4 months. We know that's how monetary policy works, the lag effect. So in my opinion, and it's obviously going to be the wrong opinion, they've probably already done enough to succeed where they want to succeed. Unfortunately, they are somewhat dictated on by the market, as much as they like to not believe that, but we know that's the case. Another thing that I think is probably pretty important for people to remember that seems to be forgotten by the great and the good is dot plots can move, right? That's the whole point of them. It seems like everyone forgets that, when we come up to a meeting where the dot plots are allowed to move, some people then remember that. And it's, what they're saying now is not logged in. We're so data dependent on it almost feels like, the landscape or people's outlook or what people believe should be the next course of action is dictated almost, on an hourly basis based on whatever the last data print was. And I think there's a lot of people having their kind of, what you'd say, kind of core views, not to lean on the old core inflation effect, but their core views are so becoming so shaped by whatever they've last seen in the data, which isn't the way to play it. We know you've got to take a step back. If you do zoom out, I know I'm a massive fan on zooming out on kind of data, charts, whatever you want. Inflation is now going the right way. We've lost the velocity. It's coming back in line. It's not going to happen. No one's, if you're sitting there expecting a 2% print tomorrow or the next data release, you're an idiot, right? We know this. But these things, the whole oil tanker analogy, it takes a while to get turning, but once it does, it keeps coming around. In my opinion, the Fed have done enough. In my opinion, we're not going to, we'll get onto this in a minute, but in my opinion, the BOE have probably done enough already, because it's, what will central bank do now that will have an impact tomorrow? Nothing. So, I'm not a big believer. I'm really kind of falling out of love with the whole everyone just this all shout at central bankers. It's not my cup of tea anymore.
What?
That's how Dick makes a living, isn't it?
Yeah. I just don't. Whatever they do, they're going to be wrong in everyone's opinion. I don't think they can. I don't think they've got the tools to do. This remember as well, and obviously, basically, I could have this answer for each segment of our show. It's been a supply. The inflation has been from the supply side, right? We're still coming out of the COVID issues. People have almost forgotten about what caused all of this, and it was COVID. Prices ramping up because of that. I think we're kind of using the wrong. Well, people are expecting the wrong results from the wrong tools, and I think that's why the market and monetary policy price, like the market and Fed officials and central bankers are on different pages, because I think central bankers know that they can't really do anything for this current situation.
No, it's an interesting one, and you're right. I mean, I guess the concern when it comes to inflation is, are we or have we moved from this being a supply issue to now the second and third round effects of that starting to come through. And maybe we can get onto that when we're talking about the BOE and after that inflation data we had out of the UK this morning. Ioan, I want to bring you into the show. What are your thoughts on the Fed? And particularly, this is almost a case of who folds first. Does the market fold in its view that they're pretty much going to stay where they are, or do the Fed fold on this idea that they're going to raise rates twice more?
I don't know. Excuse me. Like Ryan said, I think at this stage, I think raising rates is just pushing on a string. We've already talked about the lagged effect, how it takes 9 to 12 months for any sort of rate hike to feed through the system. So we're getting to the stage now where we get those annual comps. So it'll be completely different. Scenario looking a bit down the head, but I mean, if we're looking towards Powell's testimony for the next couple of days, I mean he's going to get hammered, right? On but he is though, right? I mean, like they're there, and they'll talk about the potential for millions of job losses if they keep monetary policy so restrictive. We're constantly having this upward revision to rates as it is. So he's going to, again, they're going to go say to him, well, right, you're going to impact, individuals and businesses alike now. I mean, they're in danger, the same thing that, when we talked about Elizabeth Warren there. I mean, she's going to come out, you're endangering the livelihood of Americans, by cutting off credit, blah, blah, blah. But having said that, remember before when we talked about how after the debt ceiling debacle, the market would sort of shift focus onto the next thing, and we sort of said, well, the next thing's probably going to be a recession. So does the market think that once these baked in rate hikes then are out of the way, that the recession comes into focus, and then the Fed will have to react to that? I mean, personally, I look at the leading indicators. I mean, they've been on a sharp decline since the second quarter of 2022, and the rate that it's falling, it's every single time it's fallen at this rate since the 1960s, the US was already in a recession.
Okay, right, so on that point then, just to cut in on that, because this is something that I've been thinking of a little bit. So you're right, the leading indicators are saying they're screaming recession, right? But they're screaming, based on everything we know and everything that's happened in the past, they're screaming a recession for right now, yeah? But we're not in a recession right now.
No. But again, it's about pricing in
yeah, but what I'm saying is, I think there's a very decent chance that these leading indicators and whatever start turning positively before the US has actually got into a recession. So this is why I genuinely don't think that they're going to have a technical recession, because I think everything that's pointing, the red flags and the sirens are going off, the recession klaxons have been going for months, but we're not in a recession. So all we need now is some of that data to start picking up, which it probably will do because everything's all cyclical. And so if that data starts picking up before the US has entered the recession, it'll be like, what recession? And that's just something that I just, it's the whole, same analogy. It's almost like that, people complain about bad breadth in the market, right? There's so many, hundreds of stocks are underperforming versus a few. Okay, but if those underperforming stocks start performing, then we're all of a sudden going to get a huge another leg higher. And so it's not just always the negative connotations. Anyway, sorry to interrupt.
I'm looking. From an analyst point of view, when you look at it, you have to look at all these different indicators in isolation, right? So I agree with price is what matters, right? It's not. I'm just saying this is potentially things, especially that long-term fund managers will look at, and then they'll make little adjustments to their books as you go forward. But I mean, talking about pricing. I mean, for instance, now at the headline index level, the S&P is trading on nearly 19 times the forward PE ratio, right? I mean, the only time in the last 40 odd years that's been surpassed is during the bubble-like phases.
Yeah, there's also how many more trillions are in the market now. So the valuation.
Exactly. The other thing that we've talked about there is the debt ceiling debacle, where there might have been some money on the sidelines waiting for this to get done. And the flip side of that is how much money now goes into the new issuance that the Treasury General account needs to do, or the Treasury needs to do to fill the coffers back up. But again, we're all very mindful of the fact that it's the mega caps that have been driving the overall index valuations on this thing. Obviously they've rallied. We've looked at Nvidia now joining the crew. But I mean, the forward PE ratio for the 10 biggest names is nearly 29 times, and for the rest of the market, 16 times. So, I mean, going back to, what we were talking about there, it's, the Fed only has essentially one tool to fight inflation, right? And that's raising interest rates.
Yeah.
But that's all they can do. So, they're going to be led by market forces, but like Powell said, I mean, without price stability, the economy doesn't work for everyone. Sorry. So it's like, well, what do they do next?
Yeah.
Well,
I do agree with all that. I'm just, I'm trying to be the optimist in the room.
Well, I'm certainly never the optimist in the room.
This is true.
The last thing I want to say on the Fed before we move on to the ECB, another favourite topic of everyone's, is the other thing we've got to remember is every day that rates stay where they are is another day of restrictive territory. It's another day of financial conditions tightening just that little bit more. So, like you said, Ryan, even if they don't do anything, there are more loans, more mortgages, et cetera, being refinanced at these rates every day. And that's where the lagged impact comes from. And it really pains me to give you credit.
But then that then impacts demand going forward. So you have
exactly. There's a huge argument for just saying, look, let's just sit on your hands for a few months and see what happens. Yeah, I know that inaction is like frowned upon, but
isn't the stock market being so bubbly, creating wealth indirectly and counteracting the Fed raising rates the whole time? So every time the stock market rallies, Americans feel richer, going to spend more money, and it's inflationary. And I think they've actually caught right in the middle there. And the other point I just want very quickly before moving on to make, and it applies to all the central banks, are we looking at old-fashioned data? Are we looking at LEI, leading indicators, because we've always looked at them, and forgetting that we're in a post-COVID world now, where the whole world is changed and employments have changed and how people react to what they buy.
I think you're exactly right. I think you could even say since the financial crisis, I think a lot of the measures that we've always relied on because they're in the textbooks. I think so much of that is outdated. This is why I hate this whole trying to judge the PE ratios these days, because those kind of norms are pre global financial crisis norms, and since then we've had trillions put into the economy, trillions into the stock market. So of course valuations are going to go up. But
yeah, absolutely.
That's for another show.
Indeed. Right, we must move on. We must move on to the ECB.
Talking about the Fed.
Right, ECB, let's go. I feel like I need to draw straws as to who I'm going to give this one to, because no one really wants to talk about the ECB. Ryan, let's go to you.
Next question.
Well,
sorry, I think someone's at the door.
Given that none of us were actually around for the ECB decision last week, I hope everyone has done their homework and swatted up on what they did and said since. Obviously, a 25 basis point hike, guidance towards that for July. The hawks have been out and the sources' stories have been out saying that they're going to do the same in September. I guess the first question is, we've got a bit of a divergence going on here. The Fed, the market thinks are pretty much done or at least very close to it, whereas you might have 50, maybe more basis points worth of tightening coming from the ECB. So is that going to be a bit of a supportive factor for the euro? We're nearing 110. Can we get through it?
I will caveat everything that I say now that one, monetary policy isn't my strong suit. I don't know what is my strong suit. And two, I absolutely fucking hate the ECB, so I'm probably not the best person to lead on here. But
you can have a point for that.
We'll see what I can make up on the fly, right? So the ECB again, without trying to repeat everything that we said before, what can they do that will have an impact right now? Probably not a lot. Again, lags. I know everyone likes to criticize the BOE more than anyone else, but I actually think it's the ECB that are probably in the biggest trouble. Mainly because I think Germany are in massive trouble. We've just had the IFO Institute come out this morning saying that the German economy will contract more than previously expected, mainly due to sticky inflation and the toll on private consumption. Let me just get the numbers. So they expect the economy to fall this year by 0.4% rather than in March they were saying only 0.1. Now, if you've been keeping track of...
Presumably that's got something to do with Brexit, has it?
Oh, mate, obviously. Yeah. And England losing the test. Yeah, exactly.
Oh,
yeah. This is how things work, right? The colour of my passport is directly related to German GDP. But anyways, yeah. So
the time in the queue.
Yeah, exactly. So this is the thing, right? The ECB, I don't think they should be hiking at all. In fact, I would, if I was the ECB right now, I'd be sitting on my hands hoping that the other major central banks around the world hike for me, because again, it's global monetary policy is getting more and more interconnected every day almost, right? So if there's hikes going on elsewhere, it will feed through into your own monetary policy, de facto. Bearing in mind that we could have a situation where the ECB hike another 2 times, so 25 basis points both times. By the time they do that, Germany's in a deep recession, and then they're going to have to flip it, and they're going to be cutting as fast as possible, because obviously Germany is the euro, right? We all know this. I would not want to be them. If they need some optionality, which they haven't really got at the moment. It doesn't help that kind of Lagarde seems a bit clueless. Philip Lane, who's the de facto leader of the ECB, I would be watching every word he says for the foreseeable future. Obviously, he should be anyway. I did think so. Casimir was on the wires just before we came on the show, saying, it's not certain that there'll be continuing monetary policy tightening in September. I think that's because he's got one eye on Germany again. I think it's very. It's not exactly thinking out the ball. Like, it's not exactly thinking out of the box here, but it's very important that when we think about the ECB, we just think about Germany. What's going to happen to the euro? I've been, like everyone knows, I'm the biggest sterling bull. I'm probably the biggest euro bear. I think it's all lined up for them to have been completely top and tailed, as in the ECB to be top and tailed, hiking when they need to, and then all of a sudden, fuck, we've gone too far. Now we are screwed. But again, maybe they'll get saved by the other central banks. Who knows?
Yeah, I'm glad you brought that up, mate, because if you look at the data, you've got those IFO figures that you alluded to. Germany is in technical recession. You can debate the definition of that, but let's call a spade a spade. The Eurozone as a whole is in a technical recession. We get the PMIs on Friday, which are probably not going to be that pretty, let's be honest. Ioan, is this Trichet midway through 2011 all over again, where we all sit here in 6 months and go, what the hell were they doing raising rates when inflation's on its way down and growth is, basically non-existent?
Yeah, probably. I mean, obviously conditions or the reasons for the rate hikes are completely different to back then. But I mean, it's the same thing in terms of, why are they doing it, given that, headline inflation has basically been, falling every single month since October last year, right? So, and was it May's level, or was the lowest since, February 2022? So it's heading in the right direction anyway. So as we alluded to with the Fed, rate hikes at this juncture are not going to do anything at all. How much of this drop again is attributable to negative base effects from much of the energy costs from next year, which is all falling out of the equation as we go forward. You alluded to again the PMIs, they're all collapsing. Sentiment index again, like Ryan alluded to there, the IFO, and a narrow money index. I mean, especially in the Eurozone, the M1 is contracting at the fastest pace on record. German producer prices, have come right back in. And, tightening at this stage, it just shows already everything that they've done, before now is just impacting economic activity much more quickly than they probably, thought. So, the same point that we alluded to last week was, lending standards now. I mean, the highest since Trichet hike last time. So, 40% of banks are, reported, declining credit, from companies in Q1. So again, this is all the biggest since the GFC. So, the risk is that there's a monetary overkill at this juncture, and the next meeting in July, it could be even more heated than usual. I just don't. What Lagarde would probably come up with would be another, anagram soup or some whatever thing that they come up with, which masks completely, the underlying problems that they have. They just stick a Band-Aid or a plaster on an open wound every time, and hope that these things, these sort of bank lending programs, they just mask the underlying problems and they never get sorted. So then they always show up, 2 or 3 years down the line again.
Yeah, and I guess the problem now, or the difference compared to where we were a decade or so ago, is you could go too far in terms of monetary tightening, but let's be honest, Lagarde is not Draghi running to the rescue to save things a year later. And that could be the even bigger issue if it is a kind of sticking plaster effect and, papering over the cracks in the Eurozone. Dick, let's bring you in. What are your thoughts on that? And also on the currency side of things, euro dollar is perilously close to getting through that 110 mark. Do you think it's got enough impetus behind it to break through and start a bit more of a prolonged rally, perhaps?
Just going back on the points that you guys were making, there's the one great produce that Europe comes out with, and that's fudge. And they are better than anyone else at fudging solutions, be it Brexit, whatever they do, they can fudge something. And I'm pretty convinced that's what Lagarde.
Fudge, sorry.
Fudge.
It did take me a second as well.
In that regard with Lagarde.
I was like, what? I thought I was the one that swears.
I never swear. There's always had this inattention between Northern Europe and Southern Europe. I noticed yesterday, Schnabel's very hawkish still, and then the French are much less so. De Gaulle, I pronounce his bloody French name. So, and going right the way back, and I know I always harp back on history, Germany has this understandable obsession with inflation. And I think that actually that they will be the last to push for cuts. They've got their own inherent problems. Immigration, I think they've taken in 1.3 million people this year, which in itself is inflationary. I also think that to disregard the energy crisis will be a bit premature. I wouldn't be at all surprised if you see Putin trying to squeeze things again. Certainly if things start going wrong in Ukraine. I think there's price pressures in the food industry, certainly in wheat, and watching, as I often do, the US commodity markets. They've been whacking around all over the place and been very, very well bid recently, soft commodities. So I don't think inflation's beaten quite yet, but as always, they will fudge it. I think you might get another 25 basis point and then they'll just shut up, go away on their holidays and nothing will happen. On the euro, to me, it's a straight currency play against the dollar, and it's a straight interest rate play against the dollar. If you think that the Fed's going to be more hawkish than the ECB, then you sell the euro. I did notice, and I'm no fan of people looking at CFTC open interest, there's a record number of longs on the euro. I know it's a tiny amount compared to the FX market, but maybe that's symptomatic. And if it does break, then it will turn quite sharply lower. I'm not convinced it'll break 110. If it does, I guess you're looking for 114, but I just don't see it.
Yeah, I think.
Can I just jump in and disagree with my?
You have now.
You have.
So Dickie suggests that that Germany, the German politicians, German government won't be wanting a cut. I completely disagree with that, because we know for a fact that Germany hate borrowing. They hate borrowing at significant rates, or anything above zero. They didn't even like borrowing at negative rates, when they had the opportunities, right? I saw a report out yesterday. I can't remember the exact details, but basically it was speaking about a almost like a shadow expenditure in the budget, in the German budget, basically via special situation kind of releases of cash, right? And it's basically almost the same as their official budget. So Germany have got more debt than they've ever had before. They hate debt. We know this. So bear in mind they're also in a recession and it's looking to get worse. I think, contrary to what my learned friend has said, I think it would be the Germans are bashing on the door of the ECB, saying, do not cut, do not raise anymore. Can we cut? Because they are in a very precarious situation right now. And most of it is because of the debt burden. And again, they fucking hate debt.
How much influence do the Germans actually have at the ECB? Remember, they had Weidmann there for years and years, and he could never get anything he wanted.
Well, this is the thing, right? So there's that whole tinfoil fedora about the reason he left is because he could see the divergence between the ECB and what Germany needed. And the theory is, or the conspiracy, the rumours are, that he jumped ship because he knew it'd be political suicide for him to be the face of Germany in the ECB domestically.
I completely concur with that. That's why I just don't think that they have as much influence in some of these European institutions that people think that they have. It's almost as if they're there just to have their pockets picked. But
then at what stage, if they're not having any input, at what stage do the politicians make it clear to the populace that the ECB aren't listening to us, or the EU aren't listening to us, and then all of a sudden there's populist uprising? I'm not saying like pitchforks. I'm talking about in terms of I'm not saying we're going to have a Grexit with Germany or Grexit, but the anti-ECB feelings are definitely like taking a bid, right? And it could be a very interesting summer if the ECB are hiking and Germany are having some serious domestic issues at home. So they kind of already started having. So
I just think that Germany's the German population and German politicians are much more scared of inflation than they are of borrowing, and that's just a historical. Reason.
Also, I suppose there's still people alive from the Weimar Republic, right? So they're probably
it's still very much in their psyche.
Yeah, exactly.
And that's,
don't mention the war.
The floor.
Right, before Ryan gets himself in trouble, let's get on to safer ground with the Bank of England. Well, there's only one man we can turn to for the Bank of England, the Trading Blows special correspondent, Mr. Richard Matthews. The old lady on Thursday, well, today, when you're watching this actually, meeting again in no press conference, no new forecast. It is just a straightforward decision statement and minutes from the BOE. Comes in the aftermath of a pretty disastrous inflation number once again. Headline inflation at 8.7% year on year. Core rising to a new 30-year high north of 7%. What are we expecting, Mr. Matthews?
Oh,
what on earth is that?
Oh, I see what he's done.
A special theme tune for the Bank of England comments.
Who on earth helped you make that?
Yeah, I was going to say, this was 2 hours in
I did it a couple of weeks ago.
My grandson. I should put a hat on, especially for him. I don't know. It's just excuse my language, an utter shit show, isn't it? We've got the worst inflation certainly out of the big three, out of Europe and the States. I don't think they've got a clue what to do. I get really, really annoyed when you hear politicians saying, you've got to help people with mortgages. It's 30% of the population, or just over 30% of the population have got mortgages. And I'm sure not all of them are directly affected. The banks actually should have stress tested them. So I think that's an absolute non-starter. If you've overborrowed, tough. If you've overborrowed to make tax-free gains, tough. You're wearing it. I thought the one thing which actually cheered me up today was that PPI.
Oh, wait, stop, press.
Yeah,
Something's cheered you up.
Yeah, that PPI was dropping and quite rapidly, which should herald a drop in inflation. Whether you see inflation drop as quickly as Sunak wishes it to, I don't know. And it's quite amusing, and I'm no fan of any politician, and certainly not Sunak. I think it's quite amusing that Sunak wants to see growth and the growth up and inflation down. Well, you're not going to get both. You're going to get inflation down by destroying growth, which is the great danger. What do we get tomorrow? I don't know. Is Tenreiro still at the
Sadly, yes. This is her last meeting, though. I've got a bottle of champagne in the fridge already.
Well, she'll probably vote for a drop, won't she? We should get 50. I've got a sneaking suspicion we'll only get 25, although the Bank of England is under a lot of pressure after last week's appearances in the House of Commons and House of Lords. So they are under pressure. They've got the worry of disappointing the markets, which I think it should weigh on their shoulders. Whether it weighs on Bailey's shoulders, I'm not sure. It seemed described the speed of a mollusk and the intellect of a banana in the press at the weekend.
That's better than Mark Carney's description of him, wasn't it? As a sexy turtle. I mean, my stomach still turns at that one.
Astonishing, really, that they come out with it. I think we'll get 25 basis points tomorrow. We should get 50. It's a political hot potato for Sunak now. I was amused to hear Jeremy Hunt earlier talking about higher for longer in terms of mortgages and interest rates. Oh my God, you've suddenly started listening to the Fed and you're mixing your metaphors up. But, the country gets what it deserves. 3% of the population think interest rates have dropped in the last 6 months.
Yeah, so that.
What the hell do you do when you've got a population like that? You get what you deserve. And then retail sales are good. You see, next forecast, they've upgraded their forecast for this year, which I'm really, really surprised at. They're probably based on Ryan's shopping there.
In the kids department.
No VAT, mate. No VAT.
So I think we get 25. I think despite, I'm going to disagree with Ryan, I think there's a lot of good news in sterling. If you get 50, it might pop up. But I can't see it holding on for too long, much above 128.5. It's just as I said to start with, just a shit show. Excuse my language. It's a technical French term.
Nick, just one last thing. I'll bring the other guys in a second. How high do you think bank rate gets? Markets be it north of 6 by the end of the year.
But I still think 6. I think it should be 7, but I think it will peak at 6.
Momentarily went back onto the floor there, didn't you? With
not that's 7, that's 6, that's 6.5. So 6.
Right, before Dick does anything else strange with his hands, Ioan, let's bring you in. What are your thoughts on the BOE? I think that the interesting point that I took away from this inflation number that we got this morning was that if you look at core inflation in Europe, it's in a nice downward trend. If you look at core inflation in the US, CPI, PCE, in a nice downward trend. It's like that in most developed economies. In the UK, it's going absolutely through the roof. So, we can talk about the lagged effects of tightening and all the rest of it, but how concerned should the BOE be, and how concerned should we be with the fact that our inflation figures are once again going in the wrong and absolutely the opposite direction to pretty much everywhere else?
Well, it just says one thing, right? It screams one thing, that the Bank of England's economic models are broken, right? We've already, cumulatively, we've raised rates by, nearly 500 basis points, or in about 18 months. So we're at a level now, the highest since, was it April 2008? So we've had such a rise in interest rates, and yet we're still talking about, core CPI. As Dick alluded to there, I just think it's getting a bit political now, where everybody's talking about CPI, and the focus is on that. I think we alluded to just before the show, Michael Lewis or on all these guys now, they're just sowing seeds of panic for all these, people with mortgages. I don't know. Maybe you can say CPI now means clicks prove inflation. I don't know, but I think we should now be looking a little bit ahead. As Dick just said, PPI is just plummeted. And it does lead CPI, so we need to keep an eye on that and see what happens in the next 3 or 4 months at least. But we keep saying this. Rate hikes are going to do nothing now. What's the point of 25 basis points or 50 basis points? It's nothing. It has a dwindling anti-inflation credibility anyway. So anything they do, who does it satisfy at this stage? Nobody.
It only brings pain, right? And it won't be the right type of pain that they want. It's
and people have lost.
It's not that. Sorry, go on. It's not that good pain that you pay for, is it? It's the other.
Oh God.
Yeah. And people have lost faith in the Bank of England, which actually destroys anything they do. They're going to laugh at them.
Well, exactly, and so the only thing that we can sort of happily or not happily rely on is unfortunately rely on a policy response. But we've got MPs who are leaving almost on a daily basis. We're going to have by-elections almost every week. Every by-election is going to mean something, and then we've got a general election coming up. So we're going to have all these politicians promising this, that, everything. And I was reading something about the VAT that Labour were going to put on for private schools, and somebody from, I think it was KPMG, had gone through all the costings and everything. And by the time you make all those adjustments, the 1.6 billion disappears. It's just a ridiculous. Look, we're going to do this, but in effect, it does nothing. I don't know. I'm actually surprised the economy is holding up so well, given the fact that we're led by clowns and donkeys. So the bank is
that maybe because we always have been, and the work, the normal man on the street is still going to do whatever he's done.
Yeah, we just get on with it, right? So
this is it.
But again, if we're talking about that in terms of how we trade, sterling or more specifically cable, we're up against technicals now. What's going to take us above 130? And all the other momentum indicators are starting to get stretched now. So unless something major happens in the next few months, I think we're going to stay range bound through the summer.
Yeah. Well, we'll get on to summer markets in a second. I mean, I think the point you raised about inflation and rates becoming political is a dangerous one, because you're already starting to hear this talk of relief on mortgages. Well, as soon as you start doing that, you're just undoing any work that may have been done in terms of. They should have been
stress tested up to 7% anyway.
Exactly, and it sounds harsh, but if you shouldn't be taking out debt and you shouldn't be borrowing stuff that you can't afford, and everyone thought, everyone knew rates are not going to stay at zero forever. We had a decade and a half of zero interest rates, and as Dick has said many times on this show, this is not high. I mean, yes, it is compared to recent history, but we're just going back to where rates should be. You think neutral is 3-ish. We're just getting back to roughly where they should be. Anyway, before my rant goes on, Ryan, what are your thoughts on the BOE? And you're the world's biggest sterling bull. So,
well, I am, and to be honest, buy the dip, right? Like we've all said before, and like I've already said in the previous two answers that I've given, you got to take into account the lag effect. I think what the market's pricing is 60% chance of a 25 basis point hike. I think that's spot on. I kind of wish they weren't going to hike, but politically, Bailey signing his own kind of death warrant if he doesn't hike anything, right?
Let's hope he doesn't then.
Well, ouch. Ouch. Terminal rate, we're pricing 6%. I think that's probably too high. It's yes, core inflation is not great. It's not even sticky. It's slowly taking a bid. But as we've said already, it's like it's not having. It doesn't. It's very easy for the papers and for FinTwit and social media to say, "Oh my God, inflation's on." But what the country is carrying on. Is it? You can say, well, maybe what the readings are based off isn't truly reflective, because if the readings are reflective of the economy, we should be in a lot worse position than we are. So something to me isn't marrying quite up on that thing, on that element. Something I thought was quite interesting was a Lloyd's Bank report, which for those that don't know are like one of the biggest high street banks in the country. They did a report on the delinquency rates on their credit cards. They're not really moving. So these rates aren't impacting people as much as the mainstream media or the financial press would like us to believe. Something else I think is worth looking at is 2-year gilts. 2-year gilts are right now trading just a fraction, a couple of pips over 5%. What happened the last time they were up here? Our Prime Minister got the sack. So Liz Truss, bless her, we look back and she probably made some good decisions. It's just she was like, trial by media, and now she's out the door and the rates are still here anyway.
I think, I agree. The policies I think were right. I think the thing you got to remember, and I was guilty of this until I was pulled up on it, is bank rate is 250 basis points higher than when Liz Truss was in charge.
Oh yeah,
you expect gilts to be higher.
That's true. And also, you got to take into account the velocity as well. But let me make my point. You're right. One thing I thought was we're having kind of mixed signals as well now from the Bank of England, from the MPC members, which I think is the big concern. I'd be more concerned about that than any other language that we're seeing. You've got, there's 9 people on the MPC. Last month we had a 25 basis point hike to 4.5% with a 7-2 split vote. Temrero is her last meeting, so she's going to have a say. She's not going to be voting for a hike. If she does vote for a hike, she's doing it just to piss off everyone, because it would just be you've got Dingra saying that focus should be on the medium term, not looking at today's inflation because of the lags in monetary policy transition. If we do, we're not going to hike 50. I'll be shocked if we do that. Hike 25, but again, I don't think it's going to be unanimous. And I think you're going to get some serious questions asked regardless of what they do. In terms of cable, I think today's reaction to CPI was quite telling. Okay, yes, inflation is higher, therefore increasing chances of rate hikes. A month ago, that would have been a bid straight into sterling, especially into cable. That didn't happen, and it's the market kind of going, well, hang on, we're already kind of max long. We're now concerned with not a case of, we're not now looking at say, okay, well, we're going to Bank of England are going to hike rates, which is bullish sterling, but hang on, is the UK in some serious trouble? Which is why it's getting a little bit more interesting now. Personally, as we know, as you've alluded to, and as I always say, I'm the biggest bull there is in cable. I would not be buying it here. Would I be selling here if I was long from a lot lower? I'd be taking some profit, but I would definitely not be going short. I just, there's too much at play at the moment. And like what I think it was Ioan said, or might be you, Michael, I think this summer could be a summer of inaction in terms of what to do in terms of markets, but obviously we're coming on to that in the next question.
Indeed, that's a nice little segue there. It was you and it wasn't me. I can't take any credit for that one. But I won't say any more because I'll ruin Ryan's smooth transition into the last one. Right, it is summer. The cricket is on, albeit perhaps not the result we wanted in the first test yesterday. Ioan, how do we trade summer markets? There's a lot going on, relatively little movement, implied vols are falling, realised vol coming down. What should traders be looking at, and how should they adapt?
You mean, should you trade on?
Well, yeah, I mean, even should you trade is the bigger question.
Well, yeah, I mean, it's just as much of a question as like, how do you trade or should you trade? The only thing that can tell us that is, is headline risk, whether the volume is there, whether you can get in or out of the trade. But I mean, obviously, summer markets are characterized by low volatility, high volatility, but more often than not low volumes. So it does give off a lot of false signals. It's not really a time where you take any aggressive positions. If you've got longs, you probably stay with those. If you've got shorts, you stick with those, and you just try to trade around the positions that you already have, perhaps using derivatives. As spreads tend to be wider again, position sizes have to be smaller. So again, I mean, personally, I think if you're already invested, then you just protect whatever you have. I mean, you have to be more vigilant of headlines. Maybe use something like PiQ. So you can feed that into your decision making process. But it's weird, like we've always mentioned, how all these volatility measures are not really giving off any signals. So we have to go by what the price is telling us. But I mean, like for instance, the VIX, I tend to use the spikes index as opposed to the VIX. So the spikes uses the options of the SPYs rather than the SPX itself, and it's. I think it gives off more of a signal, but other than that, when we're talking about summer markets, we just sit on our hands and we become more reactive rather than proactive, I think.
No, I think you're right. Ryan, let's go. I mean, we all know where you're going to be spending your summer.
He's literally used the word for word my line I've got on my little crib sheet.
Watch PiQ Suite.
No, that as well, but more like the react rather than predict. You absolute bastard. Sorry. Yeah, so I'll be at the cricket, mate. I don't give a shit. So basically everything what Ioan said to the word.
I've never seen him speechless before.
No, I'm like, oh, I can't believe he did it.
Is that good for being speechless?
Well, that's my version of speechless. Take it. I think I said on a previous show that beware summer markets. It could be the first traditional summer markets we've had for a couple of years now. So we're due a very quiet summer at some point. But however, saying that, and my big belief in summer markets is you sit on your hands for as much as possible, react rather than try and predict, like my learned friend Ioan said. However, my concern is that there's a few markets out there, namely look at gilts, that are kind of really on the kind of the rev limiter of of their stability. So if we have some liquidity drop out, as we normally see during summer markets, many people probably won't believe this, especially if they're new to the industry and stuff, but things like gilts, which are mainly controlled by GEMs, gilt edge market makers, that market is basically just huge desks manned by a few people and a few banks. So if a few of those are on holiday, or a few of the big players in that are on holiday at the same time, liquidity in those markets, especially 2-year gilts and stuff, will just collapse. And it's very easy to forget that there are still some markets left in the world that are like that, right? So if we're already on the rev limiter in the gilt market, and we get an extra bit of liquidity, an extra bit of something that calls a reaction, but there's no liquidity there to suck it up, we could see some proper blowouts. And obviously, as we know, a blowout in the bond market has an instant effect into the other markets. So my concern is that not a base case, but something I'd be aware of is the very distinct possibility that we have a summer of very quiet market action, loads of chop, which is what you normally get in summer markets. Maybe the S&P will just grind higher, who knows? But I don't think it will be, I don't think there'll be that many obvious trading decisions as trading opportunities. However, you do need to have one eye on these illiquid markets or more illiquid markets that have a direct relationship to the volatility of the whole industry, of the whole kind of financial market landscape. Because if we start getting some serious warning signs in gilt or the short, same with like 2-year treasury notes, whatever, which I don't think would be such an issue. It'd be, the alarm bells should be going, and we could see some bit of carnage.
Yeah, no, I think that's a very good point. I think it is too easy, perhaps, to turn around and say, it's summer, nothing's going to happen, but there is always that risk. Dick, let's finish up the show with you. How would you be approaching summer markets if you were, back in the floor days? How would you be thinking about the next kind of 8 weeks? Well, when he's not at the pub.
I'd be approaching it from St John's Wood Station. Would be my first approach towards Lords. I think so. The best way to approach it. And interesting that you're talking about cricket, Ryan. You're not taking any guests there, are you?
I'm taking a few actually.
Yeah. Not the scorer.
No. Oh yeah, well maybe. No. Michael's paying for his own ticket. Michael's paying for his own ticket.
Yeah, no,
unrelated.
Just checking.
I did my bribery and corruption training last week, so I know what I'm on about with that one.
There you go. And I took you in last year. So maybe your turn next year, Dickie.
So you know how to do the bribery and corruption.
Yeah, exactly. White envelope, not brown.
Yeah, I remember the City of London Police giving us a lecture about money laundering. They looked at me and said, "Of course, some of you here know how to do it." So I was bloody hard. I shouldn't really say that, should I? Interesting that you mentioned gilts, Ryan. I actually think that they're worth a bit of a buy as an individual. They're capital gains tax free for an individual. I think the yields now are pretty good. So I'd be looking probably to tickle some of those away as an individual, just to keep and hold. I think it's a decent yield. So I actually would be watching the gilt market quite closely. I know liquidity can go, so I don't disagree with you on that. I think we've all agreed it's going to be a quiet market, which is a dangerous thing to say. Because liquidity will come out not because we're all agreeing, but we're quite a good cross section of the market. Liquidity will disappear. People will go on holiday. Becomes more volatile. So I'd be watching the news like a hawk to see if there are any opportunities coming up and anything changing. As you know, I'm a warmonger. I'm very, very nervous about what's going on in Ukraine. I don't like nuclear weapons being that much closer to us that they are now. So I'm a little bit nervous of that. I'm nervous of soft commodities as well. So I'd be watching like soya beans and wheat. I think there's been a lot of action there. So there might be one or two opportunities. And they do trade, I'm told by my friends who trade them, very, very closely to charts. I'm not a great chartist, but I keep an eye on that. FIX, I think, is really, really, really interesting because I think it's going to stick where it is until the market decides definitively what the Fed's going to do. And I think the ECB and Bank of England actually is secondary in regards to that. I think the market will sit and you won't see any true volatility until the Fed cuts. And it's clear they're going to cut. Unfortunately, people don't want to hear this because this could be 6 or 9 months before you see anything happening there. Apart from that, I just think we're going to have a potentially very, very quiet summer, but we could see some great volatility just for an off-the-wall happening, which I have no idea what it could be. China going to do anything? They've been pretty weak so far in what they've done, so I can't see much coming out there. I suspect a few days at Lords followed by a couple of weeks in the south of France would be
ideal, mate. Ideal.
Yeah. Well, on my own without Ryan.
Wow.
You know what? There was me looking at your score. Ryan, you know I love you.
There was me looking at your score and thinking, I'm glad he's not losing.
Yeah, trying to get an extra point to tie with you.
Yeah, I noticed.
Oh, dear.
Bribery failed.
So, yeah, it's going to be an interesting summer. I think the main conclusion from that is stay alert. If you are trading, stay alert to any headlines, whether that's via PiQ Suite or Well, I'm going to plug News Squawk. I know Adam's not here, but he's here next week, so we can give them a little plug as well.
Funny story. There's a vicious rumor that a News Squawk feed might be appearing on PiQ Suite very soon.
Well, stay tuned to that, and we won't get into rumours, Ryan, because with you, we could be here all day. Beginning with art, which is results. I mean, it's a miracle.
He didn't lose.
He didn't lose, and he's tied for the win. Pigs will be flying next. You're going to hand that engraved spoon back now, Dick, I think.
I'll have to do another one.
Well, I need to keep it for luck now.
Yeah, I have to pick you one.
Oh dear, well, he's got his lucky spoon and he's happy now. Right, that brings us to the end of the show. Ryan Paisey from PiQ Suite, thank you as always. Ioan Smith and Dick Matthews in his DJ hat as well. Thank you also to please put that in the thumbnail, whoever's in charge of that this week. Thank you also to Kyriakos, our producer, for bringing this together as well. We will be back again this time next week with another show. If you enjoyed the show and stuck with it, drop a like on the video. Let us know how you're trading the markets, and we'll see you again soon. Thanks for watching, and goodbye for now.